Rachel Reeves is hunting for billions, not millions, billions. And she's got a £50 billion black hole to fill. The rumours flying around Westminster right now are absolutely wild. Some say the VAT threshold is getting slashed to 30,000. Others claim it's actually going up to 100,000. Landlords might face an 8% national insurance bomb. Pensioners could start paying NI for the first time ever. Salary sacrifice? That neat little tax hack you've been using? Yeah, that might be toast. And here's the thing that should terrify you. This isn't about one big tax hike that makes headlines. This is death by 1,000 cuts. Small changes buried in the fine print that individually sound reasonable, but together could absolutely demolish your take-home pay or your business margins. So in this video, we're ripping apart every single proposal on the table. Not the sanitized Treasury version. The real impact on your wallet. And if you want to stay ahead of these changes before they wreck your finances, smash that like button and subscribe to the channel for the latest property and tax news. Because when this budget drops, you'll want to know exactly what hit you. Right now, you don't have to register for VAT until you hit 90,000 in turnover. That's one of the highest thresholds in the entire world. Most countries make you register way earlier. But here's where it gets absolutely mental. There are two completely opposite rumours circulating right now, and nobody knows which one is real. The Daily Mail reported that Treasury officials are seriously considering slashing the threshold down to 30,000. A full-blown buzz cut. But at the exact same time, the Federation of Small Businesses is pushing hard for an increase to 100,000. So which is it? A massacre or a gift? Here's what's actually happening. The Treasury is playing both sides. They leaked both proposals deliberately to test public reaction. That phrase they keep using, under review, that's politician speak for, we're watching social media to see which version makes people angrier. Let's talk about what a cut to 30,000 actually means in real life. Imagine you're a sole trader. Maybe you do graphic design, sell handmade stuff on Etsy, or run a small consulting gig. You're pulling in 35,000 a year. Not exactly rolling in it, right? Suddenly, you've got two brutal choices. Option 1, start charging your clients 20% more and pray they don't immediately ghost you and find someone cheaper. Option 2, absorb that 20% yourself and instantly lose up to 16% of your income. Gone. Just like that. But here's the part that'll make your blood boil. VAT is charged on turnover, not profit. You could work your backside off all year, make about 300 quid profit on a job after expenses, and HMRC still takes their 20% slice like a hungry delivery driver who doesn't care if you're broke. Who actually gets hammered by this? It's not big corporations. They're already VAT registered and have accountants handling it. It's the side hustlers, the part-timers, the people running small businesses from their kitchen table, Etsy sellers, freelance photographers, mobile hairdressers, anyone trying to build something on the side while working a day job. Here's what you need to do right now, even if this doesn't pass. Start tracking your rolling 12-month turnover immediately. Don't wait until you think you're close to the threshold, because if this goes through, you might already be over it before you realise. And here's a weird twist. Voluntary VAT registration can actually work in your favour if you're buying a lot of stock or equipment. You can claim back the VAT on business purchases, so depending on your business model, registering early might save you money. Will this definitely happen? Honestly, it's hard to say. Reeves promised not to hit working people, and this would absolutely clobber the smallest businesses first, the ones with the thinnest margins and zero financial buffer. On a scale of 1 to 10, I'd put the chance of a major cut at about 5 out of 10. But here's the sneaky bit. Even if she doesn't nuke it all the way down to 30,000, she could still shave off 10 or 15 grand and catch thousands more people in the net. And that might not even be the most shocking change on the table. Stamp duty, the tax that punishes you for daring to buy your own home. Right now, buyers get absolutely rinsed. You pay thousands in tax just for the privilege of purchasing a property over 250,000. But here's the twist that's got policy wonks buzzing. Reeves might not raise stamp duty, she might kill it entirely. Sounds brilliant, right? Free champagne for everyone. Not so fast. Read the small print because it gets ugly. Think tanks like the Resolution Foundation and Money Week have been pushing this idea for months. They say stamp duty holds people back from moving, creates a frozen housing market, and punishes mobility. So their solution? Scrap the tax on buyers completely and replace it with a seller's tax instead. Yeah, you read that right. Instead of buyers getting hammered, it's the sellers who get the bill. One version of this proposal only kicks in if your property is worth over $500,000. Another version says ditch stamp duty entirely and replace it with an annual property tax based on your home's current value. Imagine council tax, but with actual teeth, proper bite. Now here's where this gets painful for regular people. You bought your house 15 years ago for $250,000. Maybe it was a stretch at the time. You've paid your mortgage, done some improvements, kept the place nice. Today it's worth $600,000. Not because you're a property mogul, just because that's what happened to house prices. Congratulations, you've made a tidy gain on paper. Except now, if you want to move, you might owe tens of thousands in tax just for selling. And let's be brutally honest here, properties over $500,000 aren't just Notting Hill townhouses anymore. Plenty of ordinary homes in Manchester, Bristol, Surrey, even parts of Birmingham are sailing past that line. The threshold sounds high until you realise half the country is already there or getting close. So, if you're thinking about selling in the next year, you need to watch the budget timing like a hawk. Get a deal agreed before any changes take effect and you might dodge a monster tax bill. Wait too long and your for sale sign could come with a side order of HMRC taking a massive chunk. Will it actually happen? Big structural reforms like this take consultation, planning, infrastructure. You can't just flip a switch, so I'd put the likelihood at about 4 out of 10 for this budget. More likely, we'll see hints and trial balloons, not the full hammer blow. But if you thought selling your house was already stressful, just wait. If you're a landlord, you might want to sit down for this one. There is serious, credible talk of slapping an 8% national insurance charge directly on rental profits, not rental income, profits. Let me break down what that means in actual numbers. Say you make $20,000 a year from rent after your mortgage and expenses. Under this proposal, you'd pay an extra £1,600 on top of the income tax you already owe. No new allowances, no extra deductions to soften the blow, just more tax, straight out of your pocket. And the government's justification? Fairness. If someone earning a $20,000 salary pays national insurance, why shouldn't a landlord making $20,000 from rent? Sounds reasonable when they say it fast, doesn't it? Until you remember that landlords are already getting absolutely destroyed from every angle. Mortgage interest relief has been stripped back. You used to be able to deduct your full mortgage interest from rental income before tax. Now you get a measly 20% tax credit instead, which is useless if you're a higher rate taxpayer. Then there are stricter EPC rules. Properties need to meet minimum energy efficiency standards or you literally can't rent them out. That costs thousands to fix. Council tax keeps climbing. Maintenance costs are through the roof. Tenant regulations are getting tighter, which is fair enough, but it all costs money. And now they want to add an 8% national insurance charge on top. Research from property groups suggests this could raise around $2.18 billion for the Treasury. Some landlords would be facing an extra £885 per property annually, and the impact is already showing. An inventory-based study found that 21% of landlords are planning to exit the market entirely in 2025. That's more than 1 in 5. Letting agents are reporting a mass exodus of small landlords who just can't make the numbers work anymore. If this hits, the only smart move is to treat your rental property like an actual business. Claim every single allowable expense: insurance, repairs, maintenance, travel to the property, professional fees, software subscriptions, everything. Keep your profits as lean as legally possible. And if you own multiple properties, it might be time to seriously crunch the numbers on whether moving them into a limited company helps or actually makes things worse. Because it's not a one-size-fits-all solution. Sometimes it saves you money, sometimes it costs you more. You need proper analysis based on your specific situation. The chances of this change actually happening? I'd give it a 7 out of 10. It's politically neat, easy to sell to voters, simple to implement because HMRC already has all the data, and it raises serious money. But landlords aren't the only ones with a giant target painted on their backs. One of the simplest ways to pass on wealth has always been to give it away while you're still alive. Right now, you can gift up to $3,000 per year completely tax-free. Give more than that. As long as you survive 7 years after making the gift, it usually escapes inheritance tax completely. It's called taper relief. But here's the problem. That loophole is firmly in the crosshairs. Policy groups are pushing hard for lifetime caps on gifting. Others want to scrap taper relief altogether so fewer gifts can slip through the net. And with the inheritance tax threshold frozen at $325,000 since 2009, that's 16 years without any increase, more and more ordinary families are getting dragged into the inheritance tax system. This isn't just affecting the wealthy anymore. Think about it realistically. A 3-bedroom semi in London or the South East, not a mansion, just a normal family home. Add a modest pension pot, maybe a life insurance policy, some savings. Suddenly, your estate is way over the $325,000 line, and inheritance tax bites hard, 40% of everything above the threshold, which means that gift you're planning to help your kids with a house deposit or moving assets out of your estate too late could end up costing your family tens of thousands down the line. The smart play right now is to move money sooner rather than later, while today's rules still apply. Because if Labour does tweak the gifting rules, it's almost certain they'll apply going forward, not backwards. Move early and you can lock in today's allowances. Wait, and you might be stuck with whatever new restrictions they dream up. I'd rate the likelihood of this happening at 6 out of 10. It probably won't be headline policy. Reeves won't stand at the dispatch box and announce it dramatically. But it's exactly the kind of thing that sneaks into the fine print of the budget document on page 47, and you only notice it when HMRC is already knocking at the door demanding payment. And if you think that sounds sneaky, wait until you hear about the merger that could change how every single person in the UK gets taxed. There's a big idea floating around Westminster right now, and if it lands, it will fundamentally change the way every person in this country pays tax. The pitch sounds harmless. Cut national insurance by 2p, then hike income tax by 2p to balance it out. Revenue neutral, right? On paper, most people wouldn't even notice a difference in their payslip. Same money out, same money in. But here's the sting, and this is crucial. It's not about how much you pay, it's about who pays. Because right now, national insurance is only paid by employees and the self-employed. That's it. But landlords collecting rent, pensioners drawing income, company directors taking dividends, they don't pay national insurance. They escape it entirely. Shift that tax burden into income tax instead, and suddenly those groups are paying too. Every single one of them. Overnight. The Resolution Foundation reckons this move could raise £6 billion a year without the government ever having to admit they raise taxes. It's the classic magician's trick. Look over here at the 2p cut while we quietly expand who's actually paying over there. Same money, different pockets. For you, depending on how you earn, this could be massive. Landlords lose another big slice of rental profit. Dividends stop being the neat little tax-efficient loophole they used to be. Salary sacrifice schemes become far less powerful because the savings shrink. Pension planning needs a complete rethink. In other words, if your income doesn't come from a standard employment contract, this reform could hike your tax bill overnight. No fanfare, no front-page headlines, just a new financial reality. And here's the kicker. Rachel Reeves has already publicly said she's open to structural reform of the tax system. That's politician speak for, we are seriously considering this. She's testing the waters, seeing how people react. I'd give this a 6 out of 10 chance of making it into the budget in some form. It's bold, it's clean, it's brutally effective at raising money, and it lets the government claim they're simplifying the tax system while actually just expanding the net. Which brings us to something that high earners and company directors use all the time, and it might be about to disappear completely. Salary sacrifice has been one of the neatest tax hacks left in the system for years. Here's how it works. You agree to swap part of your salary before tax for certain benefits: pension contributions, electric company cars, cycle to work schemes, even extra holiday days in some cases. The win is massive. You pay less income tax, you pay less national insurance, and your employer saves on their national insurance contributions too. Everyone's happy. Well, everyone except HMRC. And that's precisely why it's now firmly on the chopping block. Policy groups are actively pushing for changes. Some want a hard cap on how much you can sacrifice annually. Others want to scrap the national insurance savings altogether. And there's talk of narrowing the list of perks that actually qualify for the scheme. Here's the most alarming part about this potential change. Salary sacrifice runs entirely through payroll systems. That means Reeves could literally flick the switch overnight. No new infrastructure needed, no complex rollout plan, no lengthy consultation period, just gone. One budget speech and the benefit vanishes. Who loses the most if this happens? Higher earners who've structured their finances around it. Company directors salting away big chunks into pensions. Employees driving £40,000 Teslas on salary sacrifice deals through work. Those tax savings could evaporate in one afternoon. I'd put the odds of some form of salary sacrifice reform at 7 out of 10. It won't be headline material because most voters don't even know what salary sacrifice is. But it's simple to implement. It's politically easy to sell as closing a loophole, and it's worth billions to the Treasury. So if you're currently leaning heavily on salary sacrifice arrangements, you need to run the numbers now on what happens if it disappears. Have a backup plan ready. This is the tax grab that nobody will see coming because it doesn't involve raising any headline tax rate. Instead, HMRC just quietly moves the goalposts on what counts for relief. Right now, loads of things aren't taxed at the full 20% VAT rate. Children's clothes, books, most food. Those are zero rated. Some things like energy-efficient home upgrades or electric vehicle charging are charged at just 5%. But here's the danger. Reeves could simply bump some of these reliefs up to the full 20% rate. No big announcement, no headlines screaming about a tax rise, but suddenly your weekly food shop costs more. Your construction project gets pricier. Your EV charging bill goes up. Everything just quietly becomes more expensive, and nobody can quite put their finger on why. If you're working in a sector that relies on these reliefs, construction, education, health, renewables, this isn't just about higher prices for customers. It's also about more admin, new VAT codes to learn, new invoicing formats, more ways to accidentally trip up on your VAT returns and get hit with penalties. The Treasury absolutely loves this trick because it's subtle. It raises billions, and it's politically easy to spin. We didn't raise taxes, we just made the system fairer. Yeah, fairer for the government's bank account. The likelihood of some form of VAT relief tweaking? I'd say 6 out of 10. It won't grab newspaper headlines, but if it happens, it'll quietly siphon thousands from small businesses, and nobody will notice the full impact until they're already bleeding money. And when you add this to everything else on the table, you start to see the real picture of what Reeves is planning. So based on everything we've covered, every rumour, every leaked proposal, every think tank suggestion, which of these tax changes are actually likely to land in Rachel Reeves's first budget? Here's how I'd rank them from most to least likely, and this is based on political feasibility, revenue potential, and how easy they are to implement. Number 1. National insurance on rental income. 7 out of 10. It's politically neat, easy to justify, and raises serious money. Number 2. Salary sacrifice reform. Another 7 out of 10. Simple to implement and most voters won't even understand what's being cut. Number 3, VAT relief tweaks. A sneaky 6 out of 10. Won't make headlines but quietly raises billions. Number 4, the National Insurance and Income Tax merger. 6 out of 10. Structural reform that expands the tax base without technically raising rates. Number 5, inheritance tax gift changes. 6 out of 10 likelihood. Perfect for burying in the fine print where nobody notices until it's too late. Number 6, slashing the VAT threshold down to 30,000. I'd put that at 5 out of 10. It would cause a massive backlash, but the Treasury is definitely considering it. And number 7, the stamp duty replacement with a seller's tax. That's more difficult to implement quickly, so 4 out of 10 for this budget. So what should you actually do with this information? Don't panic, but definitely don't wait around either. Because even if just 2 or 3 of these proposals go through, the cumulative impact on your business or your income could be way bigger than it looks on paper. This isn't about one giant tax hike that makes the front pages. This is about 5 or 6 smaller changes that individually sound reasonable, but together fundamentally reshape your financial reality. Your take-home pay shrinks, your business margins get squeezed, your property becomes less profitable, and it all happens gradually enough that you don't realise how much has been taken until you sit down and actually do the math. The real strategy here is death by 1,000 cuts. Small changes, buried clauses, technical adjustments, each one defensible on its own, but together, it's a completely different tax landscape. And by the time you've adjusted to one change, 3 more have already hit. If you want help navigating any of this, whether it's VAT planning, property income structuring, or setting up smarter salary arrangements before these changes potentially kick in, book a free call using the link in the description. And if you found this breakdown useful, if it helped you see what's actually coming instead of just the sanitized Treasury version, hit that subscribe button. Because when this budget actually drops, I'll be right here to break down exactly what passed, what got cut, and, most importantly, what it means for your wallet. No jargon, no political spin, just the real impact. See you when the hammer drops.